Good afternoon, everybody. Today I'm chatting with Jeffrey Christian from CPM Group. In this interview, I asked Jeffrey for his thoughts on the mainstream media discussing the de-dollarization of the US dollar as a global reserve currency. We discuss how various central banks are purchasing gold. We get into the metrics that Jeffrey likes to use to analyze precious metal markets, and I even sneak in a question about copper at the end. All right, everybody, enjoy the interview. Jeffrey, thanks so much for joining us today.
Oh, it's a pleasure.
So over the last few days, both Fox News and CNN have ran pieces on the de-dollarization of the US dollar. One of the reasons that I'm happy to have you here today is that you're normally somebody who doesn't really get caught up in all the sensationalist headlines, looks at stuff from more of a rational, objective view. Jeff, should we be concerned about the de-dollarization of the US dollar?
Yes and no. I mean, from a long-term perspective, the idea of the dollar as the reserve currency of choice, the sole reserve currency of choice, will go away. But that's going to take decades to occur. In terms of what people are talking about with the de-dollarization, no, a lot of it is not really realistic type of stuff. If you look at the world, about 58 to 60% of the foreign exchange reserves of central banks are in US dollars. And that number hasn't really changed for decades. So the idea that central banks are dumping the dollar doesn't stand up to statistical scrutiny. They're not dumping the dollar. If you look at private wealth, private financial wealth, about 70 to 80% is denominated in US dollars. And if you look at foreign trade, the vast majority of it is denominated or settled in US dollars. And even where you have stuff that's no longer denominated in dollars, you find that the settlement usually is in dollars. So the idea that the world is rapidly moving away from the dollar also doesn't hold up to statistical scrutiny. It's not really happening. If you look, it was very funny because, yes, I saw something, I think it was on CNN, where a guy was talking about the fact that Putin, in his meeting with Xi last week, said that Russia would gladly trade with other countries in Africa, Latin America, and Southern Asia in Chinese yuan. The Chinese, Xi Jinping, the Prime Minister of China, didn't say, great. The yuan is not actually convertible, readily convertible, so it has a fixed exchange rate that the Chinese government sets. And none of those other countries said, yeah, we'll trade Chinese yuan instead of dollars. Now, the reality is that some of those countries have built up Chinese yuan positions because they are selling goods and services and raw materials to China. But they tend to get rid of those yuan right away, partly because they're not convertible. So they're not really usable as a foreign exchange reserve that you might need in a crisis. So the de-dollarization isn't happening. There is a long-term trend toward moving away from the dollar as the reserve currency of choice. But because of the simple realities that, you have 60% of foreign exchange reserves held by governments in dollars, 20% in euros, 10% in British pound, Swiss franc, Japanese yen, and the other 10% in everything else, you can't move quickly away from the dollar. Central banks, for their part, don't necessarily want to get rid of the dollar. What they'd like to see is a multipolar or a multi-currency international currency regime where the reserves and the trade and everything else is equally distributed across currencies. But again, because of the imbalance in the size of the dollar market versus everything, other currency markets, That is going to take decades to come unless you want to have hyperinflation across all economies. Because to expand the float of other currencies to be competitive with the float of the US dollar would be hyperinflationary in all of those countries where those currencies are the national currencies. So it's an unrealistic thing that comes from a variety of fears and uncertainties and people just trying to scare people into buying gold and silver.
So it sounds like you think that even if we did move away from the US dollar being sort of this global reserve currency, that it wouldn't necessarily mean that we're just going to some sort of gold backed currency. It would likely be some sort of basket of various global currencies.
Baskets are very difficult to run and they don't actually make economic or financial sense. A gold backed currency, I don't know a single central bank that is interested in a gold backed currency. Because if you say you want your currency to be convertible into gold, people will say, fine, here's your currency, give me your gold. So you say, no, and so the people who talk about a gold backed currency say, well, no, we're not talking about gold convertibility. We're talking about a currency that's backed in gold. And a currency that's backed in gold but not convertible is an oxymoron. It's like, if it's backed by gold, give me your gold for your currency. If it's not convertible, it's not really backed by gold, right? So tell the truth or get off of the microphone. It's just, it doesn't make sense. So governments of the world, central banks of the world don't necessarily want a gold-backed currency, and they don't necessarily want a basket of currency. What they'd like to see is if you look at that mix, 60% US dollars, 20% euros, the other 20% everything else, they would like to see, maybe 30% dollars and 20% euros and maybe, 10% pound sterling and other currencies in there. But again, the yuan's not even convertible yet. I mean, it's a dirty float. So you've got a long, long way to go before you can have that kind of multi-currency, international currency regime that is what central banks want.
So rather than a basket, we just see more currencies used for international trade.
Right. And domestic savings. I mean, there are two prerequisites for it. One of them is that governments have to say to their people, you may hold your wealth in other currencies. I mean, Turkey does, and India. Turkey and India allow their people to have dollar denominated or euro denominated or other currency denominated savings within the country. But most other countries say, no, if you are holding a bank deposit in our country, that deposit is in our currency. So you've got to get all of these countries of the world to change their policies to allow people the freedom to store their wealth in whatever currency they want, right? And then you have to have a greater liquidity. So those are the two big obstacles to moving toward a multipolar currency system.
So let's talk about central banks and gold purchases for a second. What trends are you noticing, and what do you think it implies?
It's interesting because there's all this talk also. Central banks are running away from the dollar and they're pouring into gold. And if you look at just the data from 2022, which was a rather unique year, you saw 21 central banks buy gold out of like 180 central banks worldwide. So 21 of them bought gold, but if you look at it, only 8 of them bought 600,000 ounces or more ounces of gold last year. And of those 6, China was one. They bought 2 million ounces in the final 2 months of the year. And there's some very important things that were going on in the Chinese gold market, which led to those purchases that we should probably go back and talk about after I make this point. The 6 of the 8 were Islamic governments, Islamic states. They were the central banks of Islamic states. And you have to say to yourself, what's going on in the Islamic world that is causing their central banks to say it's time to stock up on and move some of our monetary reserves into gold, right? And then the seventh or eighth one, after China, was India, which is a Hindu country, but it has a Muslim minority that plays a very important role in its gold market. So what you really saw last year was not a wholesale central banks pouring into gold. You saw 8 central banks buy significant amounts of gold, 6 of which were Islamic central banks. So the real key is, wow, what's going on in the Islamic world that's causing these guys to buy gold? Backing up to China for a second, the People's Bank of China serves as a conduit. They will buy and sell precious metals, gold and silver, for other government agencies and for private organizations and corporations within China. And what you saw in China last year was a very strong demand in the first quarter from investors and in the jewelry industry. And then after the first quarter, you saw a sharp decline in investment demand and in jewelry demand for gold. So you had an enormous amount of gold coming into the Chinese market that didn't have outlets. And some of the refiners that were producing that gold and some of the jewelers who weren't selling so much gold in jewelry form, and some of the investment wholesalers took that gold to the People's Bank of China and said, will you sell this for us? Now, the Chinese government says the gold that you sell should stay in China. So find Chinese buyers. And from April until November, there were not a lot of buyers. There were a lot more gold being sold than being bought in the Chinese market. So the People's Bank of China, in their special trading account, had built up a lot of gold that they couldn't find buyers for. When the price of gold had gone from $2,060 in March of last year to $1,624 in November 3rd, People's Bank of China said, well, we haven't bought any gold since the middle of 2019 when the price was $1,350. And, when the price got to $1,800, $1,900, $2,000, we weren't buying. But the price is now down to $1,624, and there were signs that maybe this is the bottom. So they bought 1 million ounces in November out of that pool of unsold gold. And then they bought another 1 million ounces in December. And then they bought about 1.4 million ounces in January and February combined. So they've taken about a third of that metal. But the fact that that metal was there is kind of bearish because it talks about the lack of demand in the private Chinese market.
Okay, so you've been analyzing gold for years, and I was watching a bunch of your content this morning, and I was just sort of thinking, what's the main metric you look at for trying to get a sense of where gold prices could be heading? Would it be fair to say it's real interest rates?
We pay a lot of attention to real interest rates, but that's a longer term factor on gold. So when you say, where gold prices are headed, are you talking about the long term or are you talking about the short term? And I think that the most honest answer is there's probably no major metric that we look at because gold is affected by so many different things: inflation, currency market volatility, stock market activity, bond interest rates, Fed interest rates, monetary policy, fiscal policy, international politics, domestic politics. You look at all of those things that can affect investment demand for gold and therefore the gold price. And it's hard to say which one is the single most important one. So we, in the morning when we rise, we look at the gold price, then we look at the dollar exchange rate, and then we look at interest rates. And then we look at other markets in general, including the oil price. And then we start looking at all sorts of little metrics behind those things, like what's happening to the retail and wholesale premia for gold products. So, it's hard to say what's the single, we happen to think that real interest rates are probably the single most important factor in the long run, determining gold prices. but it's hard to say what's that single one thing that you look at to say, oh, I think the gold price is going to rise or fall today or this week or this month.
Okay. So what I was sort of getting at is, and I know that, it's almost sort of like a symbol of various factors, but when we think about real interest rates, I mean, really we're talking about inflation and we're talking about interest rates, right? So if you're able to use all those factors and, be able to come up with some sort of forecasting ability on, interest rates and, inflation, you've got a pretty good sense of what's happening. That being said, I wake up every morning, I read a ton of the Wall Street Journal, Bloomberg, Financial Times, as much financial media as I can get my hands on, and I still have no clue what's happening. So,
and that's one of the things that makes gold interesting. And it's also one of the things that makes gold extremely difficult to project. I mean, we had a client in the 80s who was building an econometric model for the gold price. And we were, he was asking us theoretical advice and practical advice, and also asking us to provide data. And as he was building his model, he would add in things. He ultimately had 33 independent variables in his model. And he still didn't get it right. But it's a very complex set of things that affect gold, which is one of the things that makes it so interesting. But it also, makes it difficult to get right.
One last question I want to sneak in with you. Copper prices. Robert Friedland tweeted out on the weekend that inventories are heading towards a train wreck with the chart from the Financial Times. We'll put this up on the video. I can show for you if you want to see it, if you haven't seen it. How closely are you following copper prices? Do you think that this is just sort of that sensational copper to the moon type attitude, or do you think copper's maybe? I know Elon Musk has tweeted out in the past that there's not as much copper demand as what many people are projecting. Where do you sit on copper prices?
Well, I mean, you talk about Robert Friedland, you talk about Elon Musk, and I think, okay, two guys I don't take investment advice from. But then you say Elon Musk has said that copper demand's not as strong as people say. And I say, well, wow, Elon said something intelligent. But let me just, it actually has to do with the copper, but it also has to do with your previous question about gold. The statistical correlation between changes in real interest rates and real gold prices is negative 16%. Yeah, that's really low. This is, it's single most important thing. No, statistically, you wouldn't say that. Actually, you might say it because that's probably the highest correlation that you'll find. Yeah.
For our audience, a perfect correlation would be either 1 or -1.
Right.
So it's in the lower quartile.
Right. So copper demand is strong. Inventories are falling. Prices are probably going to rise. The fact that reported inventories are falling probably is far less important to copper prices than a lot of people think. The same way that silver inventories on the COMEX or gold inventories on the COMEX or in London are not necessarily highly related to price changes. And the same is true in copper. Copper inventories can fall. Part of the reason why copper inventories are falling is because there are price expectations of higher prices on the part of fabricators who are buying that copper, taking delivery of it, and holding it in their own factories because they do want exposure. In the long run, there's going to be a lot of demand for copper for the electrification of the world and electric vehicles and windmills and all kinds of other stuff. But that's a long-term development that doesn't have necessarily an effect either on short-term inventories or short-term prices. So I think that, you go to Robert Friedland. Robert has been touting the oncoming shortage of copper due to the energy transition for years. And someday he will be right. but it's not necessarily an indicator that the copper price is about to shoot up, in my mind. We do pay attention to the copper price. I don't pay as much attention to it as my colleague Carlos Sanchez, who follows the base metals on a daily basis. But our expectation is that the copper price probably does have some upward strength. If we go into a recession in 2024, 2025, or whenever the next recession occurs, that'll probably hit copper prices and knock them back down, because copper is very sensitive to industrial production. But that's a cyclical factor as opposed to the longer term secular electrification of the world.
Well, Jeffrey, thanks so much for hopping on here. For our audience, if they want more commentary, some of your analysis on precious metals markets, where can they go to?
www.cpmgroup.com. That's probably the best place. That's our website. There are free reads. There's information about the various reports and services we provide investors and other commercial entities in the business. You can also go to YouTube. We have twice weekly videos that we've been posting, giving away a lot of research and analysis, which is one of the things that we do.
Well, thank you so much for joining us today, Jeffrey.
My pleasure.
All right, everybody. Thank you for watching. If you could do me a big favor, please hit that like button, subscribe, and ring that notification bell. It would be greatly appreciated. All right. I love you all.